hold off you. Okay, I'm going to introduce our guest speaker today. It's Adam Northup. He was brought on by VCC to be a consultant on the opportunity zones, and we've actually officially hired him as a staff person now at VCC. And today was your first day,
That's right.
and we've already had him in Wise County and Abingdon. Drove in from Richmond this morning. He's driving back today. What I would like to do is go around the room, if you don't mind, and introduce yourself and let us know who you're with. It'll give Adam a little better idea of who he's speaking with today.
I'm Becky O'Quinn. I'm with the Office of Economic Development at UVA Wise.
I'm Tim Parham with Town of Grundy Industrial Development Authority.
I'm Brian Haley, I'm with People Incorporated in Virginia.
Janet Schrader, I'm the CFO of People Incorporated.
I'm Margie Douglas. I'm with the Small Business Development Center located at Southwest Virginia Community College.
I'm Michelle Lowe. I'm with the Procurement Technical Assistance Center at Southwest Virginia Community College.
I'm Beverly Owens, I'm the town manager in Wise.
I'm Sarah Williams, I'm with the Tobacco Commission.
Tanya Triplett, Town of Abingdon. Kathy Lowe, Virginia Highlands Small Business Incubator.
Kathy Stewart, St. Paul Tomorrow, Main Street Manager.
And I'm Ernie Maddy, the Commercial Real Estate Loan Officer for Virginia Community Capital.
Great, and we have just in time to introduce yourself.
Oh, no.
That's all right.
Wendy Bonham, I'm with Washington County.
Great, thank you. Don't worry about taking notes real quickly because we will send out the PowerPoint to you. Of course, feel free to take notes otherwise. And we'll have a time at the end for questions. Right. And there's Adam.
And so I'm Adam Northup. As you just heard, today is my first day at Virginia Community Capital, but I've been working with Virginia Community Capital in one of their divisions, Locus Impact Investing, since June now, actually. And most of my work has been helping those institutions kind of figure out opportunity zones and not only what VCC kind of wants to do with opportunity zones, but we've kind of broadened our efforts to help clients and other kind of stakeholders that we usually work with to help understand what this program is about, some of the challenges, some of the limitations, and we have some recommendations kind of about how to move forward as well. It's been a long time since I've stood up in front of a room and actually done sort of a formal presentation like this. Usually I'm kind of seated or whatever, so bear with me if I'm kind of walking all over the place, Sandy, because apparently I'm also on video. There's one thing I like to start with. Thank you all for introducing yourselves, and it was, I hope, at least I picked up on, there's like all of the conversations I have around opportunity zones, there's a really interesting group of constituents. It's not just business interests and financing interests coming together. It really is communities as a whole, I think, where this is going to work well. That includes philanthropy, economic development, higher learning institutions, all these things that we just, all these groups that you're representing. I do like to start with, just by a show of hands, and this is not meant to shame anyone, and I'll tell you at the outset, almost every time I do this, the answer is low, but I'd love to know on a high, medium, low scale, what's your kind of gut level instinct in terms of understanding about opportunity zones? Is anyone a high? A medium? We have one medium, oh good, and then everyone else is low. That's so typical. I think actually when we were just in Wise, it was about the same. I think we had someone who initially said high and then I moved it down to medium. But at the end of it, we had a couple comments like now I'm a medium. So hopefully we can kind of do three things. One is spend some time helping you all get familiar with the program and how it works, kind of the mechanics of it, the challenges, the opportunities with it. Second is spend some time talking about kind of where we are today, like what's actually happening, both on the ground here in Virginia, but also I can talk nationally, because I think some of those trends will, not surprisingly, end up in Virginia as well. And then the last thing is spend a little bit of time talking about kind of what maybe, what do you need to get your head around about what you can do to really make sure this program is utilized in the opportunity zones that are in your community. So we'll do that. I will say this is a much more interesting presentation if you guys stop me and ask questions and kind of get a dialogue going. There's really, I'm not a tax accountant, I'm not a tax attorney, so hopefully I'll be a bit colloquial and happy to just have it be more of a conversation. So, and I'm happy to skip forward and backwards in the slides, like this doesn't need to be kind of a formal run through of anything. So just raise your hand or speak up. So I was talking with a couple folks about this before the meeting. The Opportunity Zone program showed up in the tax bill that got passed at the end of last year, the federal tax bill. And it was born of some kind of free market think tank policy groups. And they got it in, and it was a bit of a surprise, actually, that it got in and got passed. It's, certainly local, regional, state government really didn't see it coming. But in fact, like most business interests and kind of investors didn't see it coming too. And so people have really been scrambling to understand what is this program, how does it work, and what really is the opportunity. And so quite frankly, everyone's a bit on their back foot in that low spot still. But it has been 8 months, and there's some stuff that's going on which we can talk about. There are, and I'm going to just point to the last bullet first. This is potentially a huge program. There's really no limit to the amount of capital that could flow into opportunity zones. Well, the limit's somewhere in the trillions of dollars. I don't think we'll get anywhere close to that, but this is tapping into a pool of kind of passive wealth. There's a lot of capital gains that have been accumulating in the last 10 years since the last recession, and it's currently tied up, and not surprisingly, individuals who have capital gains don't necessarily want to sell those assets and take a tax hit right now. And this is an avenue for them to kind of reinvest that and to reinvest it locally. 3 features to it. It's on the surface, it's a relatively straightforward program. You put money in an opportunity zone fund. The opportunity zone fund takes that money and invests in an opportunity zone property or business that is located inside an opportunity zone. That's the basics of it, but it gets a bit more complicated on sort of what the rules are around that. I'm going to talk in more detail on each of these bullets, but basically, those are the 3 kind of those are the 3 entities that you need to kind of keep track of. The last thing I'll say is, as I already mentioned, this program is really born of kind of free market, kind of liberal, libertarianism kind of thinking about how to drive economic expansion. And so part of that is no regulation or limited regulation. That's a theme that is important to kind of keep in mind with this program. The statute itself was like 12 double spaced pages. It's very limited in terms of like the description of it, and there is a lot. We were talking about this before. There is a lot of pressure from Treasury up high right now to continue to let it not have a lot of rules, and so that's a good thing in that it probably makes the program really big and open and flexible. But it's a challenging thing because as an investor or a business owner, it's hard to understand what the rules of the games are. And there may not be a lot of rules that ever even get codified in a way that makes people comfortable until this program may be well underway. And I'll talk more about this. We do expect some rules to come out in the next couple weeks that should be clarifying to a certain extent, but I don't think it's going to scratch everyone's itch in terms of understanding exactly kind of what the ball field looks like. The other thing I'll say is it can be combined with any grants, any tax credit programs, any other incentives you can think of. There's no limitations from that. So it is a nice, just another piece of the capital stack that you can bring together, and from an investor point of view, you'll see in a minute, pretty lucrative. So I'm not sure why this has happened, but that question mark used to be a map of Virginia, and it has the opportunity zones marked in blue. I'm not going to spend a lot of time on how the opportunity zones were selected. You can actually read this, but basically the parameters were they were low-income census tracts, and each state approached it a little bit. And then the states were, they're giving some basic rules. Low-income census tracts, you can read the parameters there. There was some ability to have adjacent census tracts. But other than that, they said states, it's up to you to sort of figure that out. And they had almost no time to do it relative to kind of normal government machinery. And so in Virginia, basically, Virginia said to all the planning groups, hey, go out and rank your census tracts in these parameters. And bring it back to us, and then we'll add some additional parameters and kind of make the cuts. And so they did things like, if a census tract was, I think, an empowerment zone, it got rated a little bit higher, or things like that. But for the most part, I think they just drew a line and tried to be pretty equal with all the planning groups. And so when you look at the map, it looks like a leopard. It's pretty well, every area is pretty well represented. There's 212 of them. If you Google Virginia Opportunity Zones and click on the first state link, it's going to take you to an interactive map. Tim and I were just looking at it. You can draw all the way in. It's like a Google map. You can see what streets and exactly what the boundaries are. And so that's a really easy thing to do. If there are other even cooler tools out there, like Enterprise 360, which allow you to overlay other programs, geographic-based programs, so you can start to see, hey, is this also an empowerment zone, or whatever it might be. I'm not going to spend a lot of time here because this is done. There is no remedy in the statute or any way that's described for new opportunity zones to be nominated, or to take out an opportunity zone, or switch an opportunity zone. This has been approved by Treasury, and everything's kind of locked. And so for the most part, we have what we have, which is, maybe a good thing, because I'm going to talk in a minute. Time is a little bit of the essence here. That's really all I wanted to say about just kind of the tracts themselves. But before I move on, any questions? Okay. So the next entity to keep in mind is the Opportunity Zone funds. I would say funds are is an interesting word for this, because at one end of the spectrum, you will have what I think of as a fund, which is a big institutional thing like a private equity fund or a VC fund or a mutual fund that has a bunch of investors throwing money into something that's professionally managed and professionally administrated with a hefty fee, and then that group is going to take the capital and deploy it into projects in these opportunity zones. And you can read, like, if you Google opportunity zones in news, you'll see a lot of funds forming like that, a lot in the $500 million range. That seems to be an interesting place for people to be building these funds. So that's one end of the spectrum. The other end of the spectrum is me as an individual taxpayer. I could create an opportunity zone fund. And really the only rules around it right now are it needs to be incorporated or a partnership. And there's going to be, we're told, a self-certification form, so you don't need to be certified by anyone. You just need to go down the list and then check yes, yes, yes. And then you would, on an annual basis, or however often you're filing your taxes, you would just kind of recertify that and give an update to the IRS about where your Opportunity Zone fund is. So fund, while I will say fund, keep in mind, it could be just an individual taxpayer all the way up to one of these big institutional funds. The money that goes into an Opportunity Zone fund are capital gains that would have from an asset sale that normally would be taxed. So sell $100 worth of stock, and I bought it for $50. I'd have to pay taxes on $50, right? Instead of paying taxes, I can throw that $50 into an Opportunity Zone fund, and there are 3 tax benefits that I get from that, which I'll walk through in a minute. And that fund needs to pretty quickly, one note, from the time I sell that asset and put it into a fund, I need to do that within 180 days. So I have about 6 months from when I otherwise would have had to recognize and pay that tax to when it needs to be sitting in an Opportunity Zone fund. And then once it's in there, there's a test for how much that capital is being deployed. And the test is basically twice a year. You do a simple thing and say, hey, I've got $100 in Opportunity Zone fund, 90 of it is at work in an Opportunity Zone at property or Opportunity Zone business. And if you do that twice a year, you pass the test, you're good. If not, there's a small penalty you're gonna pay. I go through the details of that timing because timing in general is gonna be a really interesting thing to keep track of here. But structurally, you gotta get the money into the fund relatively quick, and you gotta get it to work relatively quick. There's some other features that are gonna cause some timing challenges too. From an investor point of view, so still talking about Opportunity Zone funds, like why would I as an investor want to put money into an Opportunity Zone fund? I've already mentioned the first thing is you get a temporary deferral. So you're not paying taxes on those gains for some period of time. On December 31st, 2026, if you still have that capital gain inside an opportunity fund, at that moment you're going to be required to pay, not that moment, but in next year's tax, at the end of the next time you file your taxes, but you're going to be required to pay that capital gains. So you have a deferral up until December 31st, 2026, or if you take out money earlier, you're going to have to pay the taxes when you take it out. The second benefit is that if you keep the money in there for 5 years, you get a 10% reduction in the basis, basically. The tax accountants call it a 10% basis, step up in the basis. But basically the way that works is if you have $100 capital gains and you keep it in there for 5 years, you're only going to get taxed on $90. You keep it in another 2 years, so 7 years total, you get an additional 5%, so you'd only get taxed on $85. So that's all. So you get a nice deferral, you get some reduction for holding it in there for 5 years, up to 7 years. The big kicker though is some healthy tax or potentially healthy tax avoidance. If you keep this Opportunity Zone capital in an Opportunity Zone fund for 10 years or more, any gain you get on top of your initial capital gains is tax-free. So if I put $100 in an Opportunity Zone fund and that fund has invested in a piece of real estate that's now worth $200, that $100, in 10 years, that's a tax-free gain. And so when you look at and I'll show you a chart in a minute, when you look at the returns to an investor who wants to be in an Opportunity Zone fund, it's a bit of that hockey stick thing. The longer you stay in, the more value it's going to be. Very intentional. This is meant to try to lock capital and wealth in a community for a period of time. And so it's very intentionally done. So let me pause there. That's sort of so we've talked Opportunity Zone, Opportunity Zones themselves. These are Opportunity Zone funds. The next thing we'll talk about is opportunity, like what the money actually needs to go into inside an Opportunity Zone. But questions? Yep.
So if you left it to 10 years, you still got to pay your taxes on the initial in 2026.
If it's still 10 years from now, you will have already passed the
So
2026 date. So
paid
yes, you've already paid that.
So the 85%.
Yeah, you will have paid the 85%.
Okay.
Yep. I know this is sort of the dry part, just making sure everyone understands sort of how this works. We'll get to some more kind of interesting conversation about what it actually means on the ground. But I do think it's important to understand this because this is how investors will think about it in your communities. The last investor point is another timing point, which is this December 31st, 2026 date creates an interesting phenomenon, which is if you want to get all the tax benefits, you need to have your money in Opportunity Zone Fund by the end of next year. If you push this line over here, the 5% goes away. And if you push it another couple of years over here, this 10% goes away. And so if you're an investor looking to really maximize the amount of tax benefit you get, end of next year is when you want to have your money in a fund kind of getting ready to deploy. This is really challenging. With the other timing stuff that I've talked about, if you don't have kind of projects already in the pipeline that are germinating, between now and the end of next year, getting new ideas kind of to a place where people are willing to throw some equity at it is not a small endeavor. So we'll see. I am not hopeful, but we'll see if there is some loosening of the grip of the timing in the rules that are forthcoming. But I think there's some real urgency here, regardless. There's a bunch of timing kind of statute written timing urgency, and no matter what, I don't think they're going to work all of that out. So there is, someone asked a question in the discussion we had this morning, around timing, and I think, within 2 years, the really excited investors are going to be playing. Within 3 or 4, you'll get everyone who wants to do it, and then my instinct is after 3 or 4 years go by, without some statute written to extend this program in some way, I think the interest is going to be gone. By then, there's probably a more macro scenario too, which is at what point does the economy turn anyway, and some of these capital gains dry up, and so it feels to me like there's a lot of urgency, and I think the communities, the opportunities and the communities around opportunity, the communities in general that are around opportunity zones and the opportunity zones themselves, I think the ones that are going to be the most successful are the ones who are going to be pretty assertive. And when I say communities, I mean all the stakeholders, and I'll talk more about that too. Yeah.
I've got a question with the timing for, say, the OZ fund investor pools that are setting up. You mentioned that a lot of those rules are still kind of forthcoming on how it's formed. Is there any kind of anticipated major back timing for like an application for those groups being reviewed and approved by Treasury or IRS?
Yeah. Right now, you had the Opportunity Zone Fund can only have started as early as the beginning of this year.
Right.
And any asset purchase you make into a business or property, which I'll talk about in a minute, has basically the same. There is some lobbying going on to loosen that. I don't think I don't know. I've talked to certain folks who are kind of in the know who think that there's going to be some loosening. I don't know. That's an interesting one, because then if you start kind of backdating some of that stuff, the potential for fraud goes up. And so I'm just very, myself, I'm skeptical the IRS is going to let that happen, but I don't know. But yeah, right now, at least as written, you couldn't do it. Yeah. Yep.
Is there a minimum or maximum amount of investment?
You could do $1 theoretically. I mean, there are administrative costs here, right? So just filing taxes is going to take someone's time, even if it's just you personally having an Opportunity Zone Fund. So I don't know. I got asked recently, like, what is the line that you wouldn't want to go below to even bother with an Opportunity Zone Fund? And I think, and my answer was a year or two from now, I'll bet we or someone will have a really cool model that says if you're doing this kind of project and it's in this kind of place and these are the parameters of it, you would only do an Opportunity Zone Fund if it's $1 million. I think it's more, at this point, like, I think it's just going to be deal specific. An example I gave is where I live in Richmond, not too far away, there's an opportunity zone that's it's a residential district. There's not a whole lot of commercial activity going on. And so I think there's going to be, and I have sort of seen it, like individual investors going in and creating an opportunity zone fund, buying up a dilapidated piece of property, improving it, and renting it out, and that's their business. And that could be $10,000 or less. You know, they may not need that much. Because keep in mind, it's also, this is equity, right? That's one thing I haven't mentioned. This is all equity. This isn't going to be loaned money. This is going to be an equity investment. And so in most of these deals, you're going to have an equity portion and a debt portion. And so, you know, figuring that out as well, like you may only need $10,000 if you're borrowing, you know, 50. So it could be pretty small, but I think it'll depend on, do you want a lot of investors or you want one? Do you, what, is it in real estate? Is it in,
So it could be either
yeah,
or. You
yeah.
could have one person doing it, or you could have several.
Yeah, you could have
And
thousands.
did I understand correctly that you can have this in conjunction with other types, like HUD zones or tourism zones or any of those types?
Yeah. Historic tax credits, grants, new market tax credits, LIHTC, I mean, there's nothing that's off limits in terms of like bringing together every incentive you can think of. Yeah. State, local, federal. Good questions. All right, so this is, as a preview, this is where most of the questions or the requests for clarity are going to the IRS and a Treasury right now, which is, what is a qualified investment inside an opportunity zone fund that you can use this capital for? And I'm going to walk through this as simply as I can. But basically, you take your opportunity zone fund and put that capital in what's called an opportunity zone property. An opportunity zone property is one of three things. It's stock, a piece of a partnership, or think of this as tangible property. So real property or plant equipment or any tangible property. A stock or a partnership then can or needs to invest in what's called an opportunity zone business. The business is the more intangible operation, but that business can also own tangible property, which is why this arrow is here. So it's a long way of saying, really, you need to be invested in an opportunity zone business property or an opportunity zone business. But I draw this chart just to show that even as simple as they tried to make it, they can still find a way to make it complex. And so having an ability to navigate this, there is some administrative and sort of just transactional costs that are going to come with this. It isn't as simple as, it is supposed to be as simple as me as an individual investor can do it, but it takes some time to sort of weed through all this. An opportunity zone business is what you think of as a business. Something that is operating geographically sitting in an opportunity zone. The rule itself is 50% of the income or more needs to be derived from active conduct in the opportunity zone. That is a tricky one, especially the example I was given this day and age with technology because of remote working. There's so many, how do you actually define 50% of income is coming from active conduct of the business? I expect some additional guidance there. But for the most part, I think if you're thinking the business is sitting physically in the opportunity zone, you're going to be all right. Meaning your employees are there, your equipment's there. Chances are it's going to pass that test. I think if you start to just try to take a piece of your operations and put it in there or something like that, that's where you got to be a bit careful. And that's purposeful. They want, the economic generation to be happening in a very physical way. There are some other rules too. No sin businesses is one that I think is really important for people to know, and that's defined as gaming, stores that mainly sell alcohol, golf courses, those types of things. And I'll let you kind of read the rest there. Again, we'll send this out, so going through every single bullet, it is something that you're free to do later, and hit me back up for questions. The Opportunity Zone property, it's tangible property, and most people go right away to real estate, which is the big kind of use case for this program. But there's an interesting and very intentional rule around tangible property that impacts real estate investing. If I go in and buy a piece of real estate in an Opportunity Zone and want to use Opportunity Zone equity, I have 30 months to increase my cost basis on that by basically double plus a penny. So if I bought something for $100, in 30 months, I need to put another $100 and a penny in. And so there's so what that means is, and the reason they did it is, they're hopeful that people are buying really rundown property and doing really, and really substantially improving it, and that they're not buying, and they're doing it quickly, like right away, and they're not buying property and just sitting on it as a tax shelter. The problem is 30 months is not long in real estate, especially if you're just now thinking of an idea, right? I mean, I don't know what your locales are like, but zoning and permitting itself can eat into a whole lot of that. I know in Richmond, I look at that and I'm like, you need 30 months just to kind of do some of that sometimes. You need in a lot of these communities, you need community engagement and alignment to get things, like people to not stand in the way of stuff. I mean, it's a real challenge. I expect that will get loosened. I think there's, the real estate players who kind of pushed for this bill, I think, have been pretty successfully lobbying to somehow make that a bit less stringent, which will be a good thing because I think it will allow projects that are just an idea phase to actually kind of end up being Opportunity Zone projects, but fingers crossed on that one. So that's the mechanics of it. I mean, that's how it's structured. That's how it's supposed to work. Let me pause there. Questions?
So a franchise could go in?
Mm-hmm. The trick there is, you have to structure that. It has to be a separate corporation. So it has to. Franchise rules I'm less familiar with. How about all this? But I would assume that there's a way to do it. Yeah.
The business with at least 50% of the income derived from the active conduct of business clause also affect with potential sales. So if a business's income is actually more, instead of a good, it's a more external.
Yeah,
you see kind of what I'm saying with the
yeah,
external push versus a service.
Yeah.
Keeping the money in the economy versus derived sales that.
I think the idea here is about operations, meaning that.
Just as long as you've got them.
Yeah.
Doing the widget.
Because that's the other obvious, what you just described, sorry to interrupt, is the other obvious sort of how does this work in a day and age when I could sell something to China right now off of eBay? So yeah, I think that's a huge, I don't think, and even if they don't rewrite it, I don't think it's that you have to have your sales inside the,
Okay.
That's not what they intended.
As long as you're operational.
Yeah. I think it's really the test is whatever they come up with as the test will be about operations. It's just worded in a way that makes you wonder, is it revenue? Is it, yeah.
Because that could have, if you're trying to pair it with other programs in the state that have they're driven by the export net new to the state of Virginia, for example, or to a geographic region kind of income. Most of the time they want to see 51%.
Yeah.
So looking at sales or business growth.
Yeah. There are definitely, so when you put together incentives, there's definitely things that are going to be sometimes at conflict and make it not a good match. The other one I've heard from a lot of developers who use historic tax credits is that historic tax credits is their equity. They don't need any more equity. Why? So I don't even need this, which is really too bad because I think this law is intended to help, fix up a lot of those buildings that they're currently working on. So I do think the devil's in the details on some of that. Certainly the intention, I think, is if you have physical operations that are employing people that are, an economic engine in there, that's what they're looking for, but we'll see what the rules look like. So let me conclude this kind of section on the mechanics. I say this because we're going into the next part about kind of what does it really mean on the ground. There's basically 4 kind of use cases for this program in terms of economic development in these zones, and we've hit on them all, but I'll do a quick refresher. One is real estate development, and real estate development sort of in 2 prongs. One is building something brand new. The other is, buying something and rehabbing it in a really substantial way. So that real estate's a really good play for this program. The second thing is starting a new business. If you're just starting a new business in one of these zones, basically you're going to meet all this stuff. I mean, there's always some parameters you have to watch for, but it's going to be relatively easy to meet. Another one is you have a business inside the opportunity zone, and you want to really substantially expand the operations of it. So make big infrastructure investments, those kind of things. Or we just talked about the fourth one, which is you have an established business elsewhere, and they want to put a big footprint of operations inside the opportunity zone. And so if you're seeing projects in any 4 of those buckets inside an opportunity zone, chances are this equity may be a good way to raise that portion of the capital stack. There will be, I think, at the end of the day, there's going to be tax accountants and tax attorneys that are going to figure out exactly how to structure it if you're meeting one of those 4 things. I think if you're outside of that box, it's going to get more difficult to probably meet the intent of what they're trying to do, and then it becomes, how much risk do you want to take kind of pushing the envelope, which some business interests will do. There is no doubt. Oh, sorry, one last thing. This translated to the slides funny when we pulled it up, so sorry about that. But, and I won't go through this, but this is an example of why, from an investor point of view, why the return is really worth the effort. The gray bar is if I didn't use the program with $100 in capital gains. The dark gray bar is if I use the program, and the assumptions are it's 7% investment rate, capital gains tax rate of like 20%. And so I've seen lots of different models like this, real simple models that try to show why it's impactful. Almost all of them point to somewhere like a 200 to 300 basis point improvement over 10 years. Over 10 years, that's a huge return, a huge bit of improvement on a return for a long-term investor. And so it is a lucrative thing if you're willing to stay in and really have faith in the project, for sure. And that's why, which I'm going to talk about in a minute, there is a flood of money coming this way. All right, so where are we today? I've hit on most of all of this. All the opportunity zones across the country, done. We were supposed to get some additional guidance from the IRS at the end of August. Didn't happen, still waiting. At this point, we think we're not only going to get some updates that we expected in August, but some more clarification, but we'll see what that looks like. I'm going to talk more about this, but you're starting to see a lot of activity like this, actually, quite frankly, people trying to get informed and get going. These are the questions, I'm not going to go through them all, that are kind of the big ones, I think, for probably all of us in the room that need to be clarified, and especially for some of the business interests to really get people ready to make some practical and tactical moves in this space. And then the last thing I would say is, and this is an interesting one to watch, some states at the state level are seeing an opportunity to add additional incentives to this. I haven't heard anything at Virginia yet. But and they're not huge, but they are potentially meaningful. The example I always give is in California, there's some pretty stringent rules around kind of environmental impact in your investments, and they're thinking of loosening that for opportunity zones. But if a number of states kind of jump on the bandwagon of like adding some additional incentives, even if they are kind of, a decrease in some regulatory rules or whatever, I can see healthy pressure from kind of groundswell to our own state government to say, hey, how else can we kind of sweeten the pot for these communities as well? So keep an eye on that. I haven't seen anything yet, and candidly, I haven't seen like states making big, like, hey, we're going to give a huge tax break of some sort to, this kind of opportunities and investment. I haven't seen that either. So the big message or one of the big takeaways that I want you guys to have, other than the timing, like the urgency, is, and this is related, there's going to be, I believe, and I think lots of evidence is pointing to, there's going to be a fundamental supply-demand mismatch. There is going to be plenty of opportunity zone capital. I think it's going to be hard to match all that capital to good projects in opportunity zones.
The capital that's invested, is it like it's just in a big pot and then distributed to the zones, or does each zone have to be funded itself?
The money goes to projects in the zones. So it could come from a big pot to multiple projects in the zones, or it could just be one opportunity zone fund that invests in multiple projects in the zone. So it could be any and all of that.
So the investor can choose, like if I wanted to invest in a zone in my county, I can designate that money only goes to that county, or does it go to a big fund that flows down that could go to the other state?
It could be all of that. Like it sort of depends on how folks want to structure these funds and what kind of investments they want to put them into and what rules they want to make around it. I don't think you're going to see, even within structured funds, a lot of, they'll have probably a general strategy. They'll say, hey, we want to do affordable housing investments in the Northeast. And then they'll gather a bunch of money or in opportunity zones in the Northeast, and they'll gather a bunch of money, and then that'll be sort of their strategy. And then I do think you'll see, I know we're seeing this in Richmond, is like local high net worth individuals who are interested not only in getting a financial return, but having like a really positive impact on the community, saying, hey, I'm going to specifically invest in a grocery store in this part of, an opportunity zone. So I think you'll see that level of specificity, but the more investors you have, the less specific I think it'll be.
So it's kind of a little bit like some of the new market tax credit funds that have designated purposes in some cases,
Yeah. I think that for funds, big like institutional funds, to gather money, they're going to have an investment thesis like that. But that's kind of where, that's where a lot of the similarities end, because like new markets tax credits are tax credits. They're not, and there's like so many rules and regulations around that. The transaction costs and the administrative costs are almost, impossible to manage unless you're an expert.
Have you looked at, because the Virginia QAP this year is now incentivizing opportunity zones for live tech development. They haven't yet. The board has not yet accepted the proposed changes, but they're anticipated to accept the changes. I think on the opportunity zone front, one of the caveats in the language in the QAP this year is specifically in regards to fund commitment. So they've tiered the incentive in the LIHTC program where you get X points if you're in an opportunity zone and X points if you're in an opportunity zone with a commitment from a fund.
Yeah.
But I think there's a lot of confusion as to how to get commitments from a fund on that. I think there's generally a lot of confusion about how it's going to work in the tax credit program this year.
Yeah. I don't know. I need to follow. I should probably talk to you after this. I need to follow, I don't know the answer to any of that. It's worth a follow-up. I think commitment from a fund is it's a will have to be a legal, handshake. There'll have to be some structuring of a contract for sure. I mean, I would guess. I shouldn't say for sure. That'd be my instinct. And so that's, an additional now administrative cost to a LIHTC deal is getting that done. Yeah. I don't know. I'd love to learn more about that actually.
Yeah, we would too.
Yeah. What's one for maybe? I'm happy to take that back and push that one and a report back out. But that's an example of kind of state level additional incentives that I hadn't gotten wind of. Interesting. So anyway, back to supply-demand mismatch. There is a ton of capital flowing into funds. You can Google, if you Google opportunity zone funds, most of the news you'll see is the creation of like $500 million funds by private equity folks or big real estate developers. You're even seeing some interesting things like Fundrise, which is a real estate crowdsourcer. It says they're creating a $500 million fund, and so the limit there is $10,000. So anyone can just go online, sign up, throw in $10,000, and they're going to invest that in an opportunity zone somehow. So you're seeing some, just kind of large-scale national efforts where you would expect, but also seeing, some other more creative ways. You are also seeing, or I'm seeing, more kind of state level and regional and local. You're seeing investment community come together to build funds. I know, and that takes the form of like, in one case, there's a developer that I know who has a big project that he wanted to get off the ground, and now he's out shopping an opportunity zone fund to a bunch of kind of high net worth individuals. Like that's one thought. So he's just saying, hey, I got this big project. I probably had the lending done. I had my own capital I want to throw in, but I couldn't quite get there. I'm going to create a fund, an opportunity zone fund, and you'll get these tax benefits from it. So that's one real tangible example. I've also seen, I went to an event last week that I was talking about with someone else already, where an investor and three parties got together. It's called the Emerging Communities Fund, I think. And they're raising $250 million to invest in Virginia and North Carolina, and specifically kind of Western Virginia and North Carolina. And so, they're out hunting for money in Virginia and North Carolina mostly, but they're also planning to deploy it there. And their play is kind of buy and rehab real estate, but then create help create some other economic opportunity around that, whether it's healthcare or higher institution, economic development, retail, other commercial development. So there, you are starting to see at kind of a regional level some pretty hefty money going that way. I think you're also seeing high net worth families, business owners, et cetera, figure out that this exists. And then they already know what's going on in their communities and are starting to come together in pockets to potentially go after this. So there is just some pure kind of market stuff happening. But at the same time, I got a call from some MBA students on the West Coast saying, hey, we're putting together an opportunity zone fund. Where in Virginia can I deploy this capital? I know that our own organization at VCC has been approached by like big banks, the big banks, and said, hey, we're pulling together an opportunity zone fund. What's there to invest in Virginia? And those are the kind of places that just have no clue what's on the ground here in these opportunity zones and what to do with any of that. It's exciting, but it's also daunting because how do we build up a pipeline of stuff pretty quickly that capital can flow to? So that's sort of the major point that I wanted you to get off this slide. There is, the other sub-point is, everything you read, everything everyone talks about, anywhere that I'm actually seeing true activity is generally been in real estate. But I think there is all kinds of other cool places that this could work well for. Solar is a big one. Solar is an investment in
potentially a farm, but also you could put it on the roof of something, and if any of that happens in an opportunity zone, this is, solar's a long-term return. So that's a good use case. Hotel development, tourism, they're like, you name it. Any sort of creation or massive enhancement of any kind of business this could work for. So I'm hopeful that those are the projects that start to surface here shortly, and not just these big real estate projects that everyone is kind of immediately latched on, which is not surprising because those are the players who quickly picked up on this law. But there's all kinds of really cool places to do it. And you can read in the middle column, but out west, I've seen a lot of examples of factories inside an opportunity zone, and all of a sudden they realize, oh, now I can finally expand. That's a really big one. And so anywhere you have manufacturing on the ground, it's another place to really consider. I'm going to talk more about this last column as we go along, but I think this is an important one, which is you are starting to see localities, regional groups come together and more assertively push this program. And I'll talk about kind of what that looks like, what it could look like, and why it's important in a minute. The best example I've seen in Virginia has been in Norfolk. They early on pulled together a little kind of pitch book. It wasn't even that amazing, honestly, and no one here is from Norfolk, right? But what they did that was cool is they put that together and then gathered a bunch of investors and literally walked them around the city and said, hey, this is what we think should go here, and this is what would go here. And oh, by the way, we're improving the infrastructure here. We're putting in new sewer, whatever it was. And so, even if all that yields is just some early energy, it was, I think, the best example I've seen locally. For any of you who want to see a really good example of what a locality has done, Google the Louisville Prospectus. They had a lot of help with it, but they pulled together a really cool pitch book that's like, hey, in this opportunity zone, we want a new hospital. I'm making it up, but it's basically, we want a new hospital, and that's going to drive this and that, and so they're actually like pitching projects, really. But that's pretty impactful because that's going to draw people in very quickly, even if they're not like shovel-ready projects. Which gets us to kind of the challenges, and this is a bit of, hopefully, getting here. You've heard me talk about each of these, but I think there's three major challenges. One is there aren't enough projects on the ground that could readily kind of grab this and run with this capital. The second is even if we had those projects on the ground, economy has been booming for a while. How do we get people to, how do we make this like attractive enough that if you're a developer and have a project you're about to start here, you'd rather start it here? Because there's only so many contractors in any given location, and they're pretty busy. And then the last one is the time constraints, which I've harped on throughout all of this. I think and I'm going to talk more about this, but in general, there's probably one major way to attack this. But there are some, you can get really creative on how to solve these things. The lack of shovel-ready projects, that's the one that requires some hefty work by lots of stakeholders, not just one party. You need business interests getting excited about it. You need local governments getting excited about it and helping kind of make sure you're excited about the right things. You need economic development sort of, kind of helping corral that to, hey, this would be the most impactful, kind of thing that could happen in our communities. Let's make sure we're investing in this. You need philanthropy, all these things. And I'm going to talk again more about that. And the time constraints. The only thing I can say there is we need to move faster than we otherwise would have liked to. The more time we all get stuck in thinking and planning, the less time we have to kind of start making some things happen. And so those things I think need to happen more in parallel than they normally do, is get some things going and take some risks. But also I think the forthcoming rules will help really tell us how bad not bad, but how limiting the time constraints are. So this is the last thing, and then I'm going to just open it up for questions and a general discussion. I think the point of view that we've built at VCC after staring at this for the last 3 months is that communities, the opportunities in communities that are really going to win are probably very early on going to have some combination of these bullets happen. And it isn't one group that is going to do all this, or one constituency. I think it's going to be really that first bullet, which I think is you need really some alignment with financial institutions like us, who are excited to get in there, with local government, local economic development, with business interests, and importantly, philanthropy. I think that's the one that in some places I've seen folks realize the power of philanthropy here. But I think philanthropy could help us with the problem of making the returns even richer and more exciting for people to go in. A lot of philanthropy across the country and in Virginia is looking for ways to invest in communities like this, and this may be finally a place for them to align to if these projects look really interesting. And I'll let you read the rest of them, but it's really it's a bringing together. It's probably, and certainly in my opinion, it's picking not 50 things, but whittling that down to like, okay, we got a somewhat limited time to do this. What are the 5 to 10 things that the community should focus on, that we should come together on from a business standpoint, get investors excited about, start working through kind of local government, et cetera. How do you narrow that down pretty quickly? And then you kind of read the rest. But I think the big takeaway that happened in our last discussion in WISE, I think, was with a similar group, but I think they all sort of came to the same place, which was, we just can't wait for the market to make this happen, even though this is a program that's supposedly designed just for the market to make it happen. We need to lean in and really help getting some things going and getting some of that capital to our community. The analogy we used is, I think you're going to get a lot of knocks on the door from the investment community, whether they're really big funds at national level or local, folks who have a fund or just high net worth individuals saying, hey, this is a great opportunity for me to deploy some capital. I think you're going to get a lot of knocks on the door. And I don't think you necessarily need to have a big pile of, hey, here are the investments that you can invest in. I mean, that would certainly be nice. I don't think anyone's going to have that. But how do you have enough to kind of open the door and welcome them in and say, hey, these are the 5 things that we're really thinking are important. How can you get excited about any of these? We can match you with the right people. These are some things that are, how do you make that a really welcoming environment for these folks so that they get kind of caught in the net and are wanting to kind of stay and really contribute to the rebound in these communities. So it's a long way of saying, how do you build your own kind of Louisville prospectus? And when I say you, I'm talking the general community that you're in, not just your organization, but how does your community have kind of a pitch book at the ready to a certain degree to get folks excited to, hey, oh my, they're thinking about a hospital here. That's really kind of what we're invested in. Or what we're wanting to invest in with our Opportunity Zone funds. We'll get in there and help make things happen. They may bring in outside experts to help kind of drive the project forward or whatever. You can see that you need it to snowball is a sort of my point, but it isn't going to snowball unless you get that little pebble kind of rolling first. And I think it's kind of incumbent on not just the business interest to get that snowball going. So that's all I got. Love to just pause and try to answer questions or open it up for just general dialogue.
Where do you see that the opportunity zones are knocking at the door? I mean, who are they going to first? The PDC, VCC, where are they really starting?
All. So I've been in state level meetings where they're saying, folks are calling the governor and saying, hey, where can I do it? And then that trickles down. We've had, as I shared, big banks, anywhere from big banks down to MBA students calling us and saying, hey, where can we invest? In the last conversation we had, someone mentioned that they've already had some investors approach, their own counties, thinking of stuff. So I think it's going to come from all over. You know, I think you are, what I suspect we'll all be surprised at some of the knocks we get on the door and from who. Like, it'll be a random place out in, you know, North Dakota that has for some reason pulled together a fund that wants to do, you know, like I could see some of those scenarios because there's just going to be so much capital out there. But I think more likely it'll be folks who already sort of know what's going on or have an idea, you know, and so that it won't be a total kind of mismatch thing. I think there'll be some connection, would be my guess. Yeah. But I haven't seen, I mean, other than what I described, which are kind of some cold call-ish things, I haven't seen a lot of just great connection yet. One of the things we're going to do at Virginia Community Capital is we're inventorying all these funds and investors that are calling us and kind of figuring out what do they want to do, what's sort of their setup, all these kinds of things. And we're talking to you and folks in your communities all the time about projects that you're doing, and we're trying to pretty quickly say, hey, is this in an opportunity zone? Could it be? And then there's a, you know, some matchmaking that we would like to do, certainly. But I think but we don't need to be in the, if we don't need to be in the middle, I think we can enable some of that. But I think you'll get folks like us helping bring some of it to the table as well.
Do you have an idea of what you think the certain funds will, what the debt to equity will look like?
I haven't gotten that detailed yet. I do think this potential, like the good part about this is that it potentially brings more equity than you might otherwise have in the deal, which makes the lending a bit easier. The tricky part, though, is the equity that comes in isn't, like the guarantee around it is a bit weird, and so it could be, you know, because it's a, you know, it's an equity fund coming in, it's not personally guaranteed, or, you know, whatever it is, like in some cases you might have on some of these projects. So I think for the most part, my guess is it'll be a good way to finance because it'll, you know, allow for a little less debt, which makes it a little easier for the deal to go around. But you know, like I already gave the example of the tax credits thing, the historic tax credits. In some cases, people are like, I don't even need it. And that's not how I do my deals, so. Did I bore you to death? Well, as I said, we'll send this around. Just so you know, typically what happens is I start getting emails from the likes of you in about a week or two, and I'm happy to answer them. Please don't hesitate to reach out. And for certain, you know, keep us in mind, just VCC in general, as you get to some of this. Like, we're here to help you kind of work through it. Certainly, as it gets closer to financing, you know, we'd love to be really attached to that. And can help push that through. But as I said, you know, we, if nothing else, we can probably help steer you a little bit to get going on some of this, and I'm happy to do so.
I'll just say thanks to everybody for coming. We would love to work with you. We're excited to have Adam on board with us to kind of lead this. And I think it would be great too, we were talking on the way back over here, that it would be ideal for, we know some folks that have done well, especially Tim in the coal fields, that, you know, this might be a great way that, they don't like to pay taxes. This might be a way that they might want to invest in some projects. And you have to be pick and choose though what you want to do it for. But I think now you need to jump at it while you can before the water gets too many people in there stirring it up. Just jump on it.
Well, I realize we've gone past 5, which is part of the reason why everyone's probably done. So thank you all. Really appreciate it.
Thank you.
Thank you.